Canadian housing market investment is tanking and will drag down the entire real estate sector. Canada's housing market has recently been a hot topic of discussion. And for a good reason. In an article by Daniel Wong in Better Dwelling on September 5, 2023, the spotlight is on the rapid correction taking place in Canada's real estate sector. In this video, we will explore the intricacies of this situation and explain why it's making headlines. Before we jump into the specifics, it's crucial to grasp the importance of residential investment in Canada. Residential investment encompasses various facets of the housing sector, including the construction of new homes, major renovations, and ownership transfer costs. This sector directly contributes to Canada's GDP and has historically been a driving force behind economic growth. However, there's a delicate balance to maintain. While housing investment is essential, it should ideally grow in tandem with the broader economy. When housing investment outpaces overall economic growth, it signals a misallocation of resources and poses significant risks. It's akin to walking a tightrope. To better understand the situation, let's rewind to the United States in 2006. The U.S. housing bubble witnessed residential investment soaring to an alarming 7% of GDP. Experts sounded the alarm bells. And they were right. The subsequent correction brought it down to a more sustainable 3 to 4%. However, it came at a substantial cost: massive job losses, financial turmoil, and global economic repercussions. Fast forward to 2023, and Canada finds itself in a similar predicament. According to Daniel Wong's article, residential investment in Canada saw a significant decline of 2.0% to $133.1 billion in Q2 2023, marking a substantial 13.8% drop from the previous year. However, this doesn't imply that Canada is running out of housing investment. In fact, when examining the dollar volume, it closely resembles pre-2020 levels. And Canada has long been known for its robust housing market. What sets this situation apart is the contrast between the housing sector and the overall economy. In Q2 2023, while Canada's overall economic output was slowing, the housing sector was contracting at a sharper rate. Residential investment dropped by 0.1% to 6.1% of GDP, a whole point lower than the same quarter the previous year. To truly appreciate the scale of this decline, we need to look at it over time. As recently as Q1 2021, residential investment represented nearly $1 in $11 of GDP in Canada. Fast forward to today, and it's the smallest share allocated to housing since 2001. The last time such a rapid collapse in investment occurred, it foreshadowed the correction of the late 80s housing bubble, a period that still lingers in the memory of many Canadians. There is a silver lining in the form of stimulative population policies that are helping prevent a complete collapse of housing investment. It's essential to remember that despite the significant contraction, Canada's residential investment remains relatively high compared to its trade partners. For instance, the United States, a close neighbor, had residential investment at just 4.6% of GDP in Q2 2023. Nonetheless, Canada is bracing itself for a painful adjustment. A rapid reduction in housing investment necessitates a rebalancing of capital in this sector, often leading to job losses and economic restructuring. It's a necessary step to eliminate inefficiencies and ensure long-term economic stability. The article by Daniel Wong serves as a poignant reminder of the delicate equilibrium between housing investment and economic growth. Canada's housing market, once a powerhouse for the economy, is now undergoing a rapid correction not seen since the 1980s bubble. While it may be a challenging period for the housing sector, it's an essential step in preventing a more significant crisis down the road. This situation highlights the importance of carefully managing the housing market to ensure sustainable economic growth. The interplay between housing investments and the health of the housing market. In the wake of Canada's housing market correction, it's essential to explore the intricate relationship between housing investments and the overall health of the housing market. The recent decline in residential investment, as highlighted in Daniel Wong's article, serves as a potent reminder of how changes in investments can significantly impact the housing sector. Let's delve deeper into this connection and examine the evidence that links declining investments to a weakened housing market. Residential investment is often considered the lifeblood of the housing market. It encompasses various activities, including the construction of new homes, renovations, and transaction-related costs. These investments fuel the growth of the housing sector and contribute directly to a nation's GDP. When residential investment thrives, it not only stimulates economic activity but also meets the housing needs of a growing population. One crucial aspect of housing investment is its potential to create an oversupply or undersupply of housing units. When investments surge beyond what's sustainable, it can lead to overdevelopment, causing an excess of available properties. This can result in falling property values in an oversaturated market, ultimately destabilizing the housing sector. Conversely, when housing investments decline, the pace of new construction and renovation slows down. This, in turn, can lead to an undersupply of housing units, driving up prices and making homeownership less affordable. A shortage of housing can be particularly problematic in high-demand areas, where supply constraints can create housing crises. To better understand the repercussions of declining housing investments, we can draw lessons from the United States experience during the housing bubble of the mid-2000s. As previously mentioned, residential investment in the U.S. surged to an alarming 7% of GDP at its peak in 2006. Experts sounded the alarm about the unsustainability of this trend, and their concerns were justified. When the bubble burst, residential investment plummeted, leading to a glut of unsold properties, falling home values, and a housing market crash. The ripple effects of this crash were felt across the broader economy, resulting in job losses, foreclosures, and a financial crisis with global consequences. Returning to Canada's current situation, the recent decline in residential investment serves as an important correction mechanism. It helps prevent the housing market from overheating and becoming unsustainable. While the adjustment can be challenging, it is a necessary step to ensure the long-term health and stability of the housing sector. The evidence is clear. There is a strong correlation between fluctuations in housing investments and the overall state of the housing market. Excessive investments can lead to a housing bubble, while a sudden decline can trigger market corrections. Striking the right balance is crucial to maintain a stable and sustainable housing market. It's essential for policymakers, economists, and industry experts to closely monitor residential investment trends and act swiftly when necessary to prevent extreme fluctuations. By doing so, we can mitigate the risks of housing market instability, ensuring that the housing needs of the population are met without jeopardizing economic stability. This video attempts to explain that Canada's housing market correction serves as a timely reminder of the pivotal role that residential investments play in the housing sector. As we navigate the ever-evolving real estate landscape, understanding the connection between investments and market health is crucial for making informed decisions that benefit both homeowners and the broader economy. What do you think? Does a slowdown in investments in the housing market signal the end of the overall Canadian housing market frenzy? Or is it just a pause in an ever-upward trajectory in Canadian real estate prices? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.